You want to be on YouTube so bad. You want to be on Market Mondays because you want to be on, or because you want to be on YouTube?
Because I want to be on YouTube.
Tell everybody, hey.
Hey, I'm going to make my own channel tomorrow.
Green means what?
Up.
Give me a company that makes computers.
Apple.
Give me a company, or give me a store that you can walk into that's publicly traded.
Amazon.
What about Target? You can walk in a Target? Yeah. Anything else you want to say to the people before I...
What up? Spider-Man's here.
Love you. Xander's been swearing he's been wanting to come on Market Mondays for weeks. Happy holidays to everyone. I love you. I appreciate you dearly. Let's start here. So, of course, you guys saw the post. Bloomberg did an article over the weekend where the title was Cathie Wood sees 20% returns after unbelievable 2020. And of course, earlier this year, we talked about Cathie and how amazing she is. And then a couple of days ago, I posted, like, are you guys really geeked over? And of course, Cathie and some of the funds made more than 20%. I'm just reading off the headline. But I was like, you guys are geeked over 15 to 20% return now because it was stated by Cathie, but Apple gave 74% return. And my initial intention was to come on here and just rant my ass off. And that is, I don't think, the right thing to do. A ranting, that would be based on ego. So I want to start this off different and ask you, with all the information that we've given. So if you would have invested in Apple 10 years ago or 5 years ago, 10 grand would have turned into 50,953. AMD is up 500%, 600%. But me knowing that these stocks are going to take off is not enough. Let me know what we could have done better that would have induced you to actually invest in these companies if you missed out in March. Please type that in chat. I really want to know. I really want to know. Because as being a part of this movement, it's not enough for me to be like, hey, I knew this was going to happen. And I know some of you are like, hey, you know, you can lead a horse to water but can't make him drink. But if you're on fire and there's a lake nearby, I need to push you in, whether you want to go in or not. So what could we have done to induce you to actually take these companies serious? Because the only path to freedom that we have is actually investing in companies. You can't trade time for money and get there. And second, so I'll go from accountability from me to you. What caused you to not buy? Because this is one of the greatest decades in modern history when it came to investing. So if you look at the most profitable indexes and ETFs of the decade, I want to walk through some. Kudos to Rashad and Azim for posting this over the weekend. But let's just look at a 10-year period of, let's start with Apple, and we'll dance through a couple. So if we go from 2010 through 2020, 10-year, look at this return. Look at this return. We are looking at almost 1,200% return. For Borno Apple, let's look at another one of the top companies of this decade. So let's go down and look at percentage, and let's go 10-year. Amazon is right at 1,700% return over a 10-year period. Let's look at Tesla. I think we all can agree, hands down. Kudos to Stock Club members that are still holding. This is why I say buy and hold first and foremost. Look at 10-year. Over a 10-year period, and Tesla was not an easy hold. Talked about a base before, and Tesla stayed within its range. For those of you that were in it for a long time, whenever it got to a high, it dropped off 50% literally from the high. And tonight, once I go through the presentation, there's a key lesson that I need you to know, regardless of what it is you want to invest in, that you need to apply. And if you do, you have a 90% probability of making gains out of the market. But Tesla's up 10,000%, 10,100%. Amazon, 1,600%. Kudos to my guy, Ty. This is one of his favorites. It's been slept on for a long time and not talked about enough. Lululemon, Let's look at a 10-year. Lululemon is up 861%. And let's go to the final one that we've talked about before, Nvidia. If you didn't invest in these, did you go look at the 5-year and 10-year returns on them? Look how much Nvidia is up over the last 10 years. And even if we look at 5, the returns are great. Okay, so let's recap the year with some of the top ones, of course, and let's just look at 1 year. So of course, Apple done absolutely amazing. And let's go 1 year and click percentage. And we can see Apple is almost at 100% return for the year. It's 80%. The companies that are great are going to remain great for a long time. Let's look at Microsoft, 42% for Microsoft. Let's look at AMD. So a lot of times, I know you guys thought when I was just saying Microsoft and Apple, I was giving away picks that had no value. That's not the case. 1 year, AMD up 126%. And of course, Apple now making their own chips. Microsoft is now making their own chips. AMD, great. Nvidia, great. That puts the squeeze on Intel. Let's look at Nvidia one more time. So this is a part, and Troy is going to do an amazing segment about how to do your homework. But 127%, and one that a lot of people slept on, that I gave away this year, that is not talked about enough. If you look at the 10-year, Mercado Libre is up 2,500%, and year-to-date, 200% return. So once again, what could I have done to induce you to make you hold these? And then what could have been done on your end to make sure that you were in the right companies? And that's why it's very important to silence the noise. The Bloomberg article, I'm sure you guys saw it. A guy became a millionaire off of Tesla. And the key point is, we all can do it. Please write this down. This is the biggest lesson of the decade. Biggest lesson of the decade. Regardless of what you believe in, and even if I don't like the stock, this lesson will apply. Hold what you believe in for 10 years. I don't care if it's crypto. I don't care if it's marijuana. Whatever you like as a investment, hold it for a 10-year period. I want us to stop flipping a 10-year period, because if we look at some of the biggest companies, if they are good, they are going to do well over a long period of time. The companies that are not doing well, you can see over time, they end up falling apart. Time definitely reveals all. So if there's a company that you believe in, I need you to hold it for 10 years. And if you're going to do that, put yes in chat. And let me walk you through a portfolio. So I posted this on IG, and I want to show you guys here in more detail. So let's say I take the top tech stocks that I believe in, and I put 10 grand in, and I just equally balance them out. And say we do a 10-year period. We do Apple, Microsoft, Amazon, Tesla, and we do 25% of each. Look at what the returns are. So they're all broken up. So you would have started with 10 grand. Your final balance would be $365,000. Look at this though. The max drawdown, the max you would have lost was negative 17%. Negative 17. Okay. The worst year would have been 6% doing that. So when you guys are looking for these ETFs on your own and you're hunting, it's like, okay, great. But if you just put 4 together, you can do pretty damn well on your own. And look at these returns. And now let's even go look over a 5-year period and do the same thing, 2015. And let's analyze. And you can see 5 years, 10,000 would have turned into 103. Now let's play with a little bit more money. And let's say we go from 10,000 and we go to 100,000. what that looks like. And even if you don't have 100, I need to show you so it can stretch your mind and you can see. Now, 100 grand would have turned into 1 million. Okay. And then if we go look at 10 years, 100 grand would have been 3.6. And then for those of you that have deeper pockets, let's look at if you have $1 million and you're in just 5 years. So let's start with 10. Keep the theme going. $1 million would have turned to 36 million and over 10 years. And then if you look at a 5-year period, and the best year was 187.65%. So of course, last week we talked about the market is only down 24 out of 195 days. That's 87.7% of the time the market is up. There is no reason to be afraid if you're holding for long term. The only time people should be getting afraid of stocks is if you are in bad companies or you do not plan to hold for long term. Type yes in chat if you regret selling off some of the stocks that you had this year. And I know some of you, and kudos to my guy, a lot of you are going to say, hey, well, great, this was a great year. Let's look at 2-year returns and let's take out 2020. Okay, let's do 2018 through 2020 and let's look at what 10 grand will get you with the same kind of, and you can use the same formula and see. This is 2 years. 2018 through 2020. Look at that return. Look at that return. I need you to hold. Please type in chat why you are afraid to hold. And let's pick some years that were not prime as well. So that's fair. So let's say 2011 through 2015. And let's see what the returns are. Largest drawdown, how much you would have lost? 13% would have been your worst year. But you still would have started out with 10 grand and made 47,000. So 4.7x growth. That's amazing. Please type in chat, long-term investing is the wave. A lot of people tricked you out of your spot and told you that you should deviate and long-term is boring. It's not. It is not. The biggest mistakes I saw made from this year. So I'm going to post a couple screenshots that I saw. Thank you guys for posting this. Not investing in top companies from the very beginning of the crash. What I want you to do is go look at the top 10 crashes of the last 200 years, and I want you to go study them. In this modern era, you got to look at tech and pharma, but whatever industries that have been decimated by the recession. So in 2008, it was housing, it was consumer things, it was residential. Those bounced very well. This crash was different. The next one will be different as well. So I want you to prepare now while the crash is over, because when you're in the middle of the storm, in the middle of the fire, it's really hard to prepare and to know what to do. Number 2, over trading. Type in chat, I will stop over trading in 2021 because I do not want to sabotage myself. I'll say it again. I will stop over trading in 2021 because I do not want to sabotage myself. Number 3, not investing more. If this is your first crash, I get it. But never let this happen to you again. Number 3, not taking advantage of the information presented here because it's free. Just because it's free doesn't mean that it's not of value. We came here every week to give you the best picks, best insights, best analysis. Number 5, day trading with no plan. It's a death sentence, but we've all done it. It's one of the most crucial ones, selling long-term investments to trade. This is the formula. So if it's your first time listening, write this down. If you've heard this before, write it down again, but actually apply it. I love that meme that's going around. 2020, you learn. 2021, you want to apply. 21 starts today. Invest first, long term, for 30 years. Then swing trade, then short term invest. Some of you will call that intraday trading. Has to be in that order. 80% of your money should go into long term, even if you don't have a lot. Otherwise, you're going to be ass out. I wanted to give you some examples of the economic moats that we talked about. So high switching cost. Apple is a prime example. So if I go to an Android and I now lose my iMessage, Apple Watch, and everything in the ecosystem that I have tied to Apple, don't like that. That's one thing that keeps people fenced in. 2, networking effect. So iMessage in itself is a small social media platform. Facebook at its prime was an example. Instagram is an example of that. TikTok as well. LinkedIn and YouTube. Intangible assets. Tiffany and Nike. Any brand that makes you feel like royalty, important, or loved as an amazing intangible asset. Number 4, the pure value of the brand. Apple, of course, Amazon, the Yankees, and LA Lakers have high brand values. The brand alone is worth billions. So when you guys are asking about other companies in comparison, if they don't have high brand value and people will not be dedicated to them just because of the brand alone, that's usually not a good long-term investment. Brand loyalty, Amazon, Apple, Netflix, Jordan brand. I think Jordan probably is the greatest example of being able to repurpose the same product in different variations and still have people dying to have them. It also goes back to the brand being the best. The reason why Jays also sell the best because Mike was the best player in the modern era. High retention. So Zappos for employees. And then you have to look at T-Mobile for customer retention. Rest in peace to Tony. God rest his soul. But T-Mobile has a pretty high retention rate for customers. And write this down. This is going to be one of the biggest gems that I'm going to give you as we wrap up for the year. And I want to thank you guys for being so amazing and all the support you guys have shown to me. Rashad, Troy, Red Panda fam, I love you. Sniper fam, love you. Alpha Apex fam, love you dearly. I need you to look at this. I need you to compare what the ratio of gains are in a company. So write this down. Ratio of gains in a company. And I need you to divide that by the drawdown, max drawdown over the last 5 years. And I need you to divide that. If the risk to reward ratio is great, that tells you that you can then invest in that company. If it is not a good one, then you have to let that company go. So of course, if you guys read Money Master the Game, you already know 5-to-1 is a solid reward to risk ratio. But ideally, you will want to go higher. You want something that gives you a higher return than that. So on the years that it loses, you don't have to worry, you don't have to fret, okay? So divide the gains over a 5-year period, divided by the max drawdown. And if it's under 10, you should probably let it go. The Fed announced they will not be tapering its asset purchasing program until further progress has been made. It's just basically saying that the economy is not fully recovered. And thank you, Ruby, for sending me this. Here's the thing. They are going to keep interest rates low until 2023. Until then, banks are probably not the best or first asset class you should go into for that reason. Once that easing is over, banks will be great. If you want to position in early, you can. Okay? And then once again, Nikola, no good. Tesla, amazing. And a lot of you have been sending me this note about Michael Burry short and Tesla. Here's what I want you to know. I love Michael Burry. I love the Big Short. But when you are looking at a position that someone else is taking, you don't know what their parameters are. You don't know why they're getting in. You don't know when they're going to exit. So I know some of you were alarmed by it, but if you don't know when he's going to take profit, it shouldn't be in your plan. It shouldn't matter. You're going to have to learn to drown out the noise of everyone else and just follow what is best for you. Of course, some news can give you an edge, but truth be told, more often than not, when you guys are looking at all this information, it's hurting your gains. It's hurting your gains. The only thing I want you to look at is, did this make me more money? And Ruby, thank you for sending it to me. Are the decisions that you are making based off this news putting you in a position that you want to be in? If not, you have to let it go. And this post, I made a while ago, but I think it was timely. In the midst of a recession, you have immense opportunities. And I'm not saying to invest in penny stocks, but when you have an incredible opportunity like we did in 2009, and no recession will look the same, no drop will look the same, you need to know the areas you want to get in advance. Your homework for today, I need you to write down, if the entire market fell apart, what are the top 20 companies you would invest in and where would you get in? As we wrap up, I love you guys. Keep a 5-year focus on your portfolio. Kudos to Jeremy for this post about sharing how much you would have had in monetary value if you would have bought the Tesla stock instead of the actual car. And if you have a truly diversified portfolio, even though the statement was controversial, you're not truly diversified. You're not. You want concentration. And for those of you who always feel like you're missing out on certain moves of the market, you're not. If you got an index fund, you have exposure to everything else. You have exposure to everything else. And stop letting people tell you that index funds or index-based ETFs do not pay a lot. That is not true. It's not true. You can go look up this information yourself. So before we leave, let me just show you one more. At the 1 year for VTI. VTI right now is at 20% return for the year. We can see that highlighted here. In 5 year, 106%. Sometimes these people that you're listening to who are telling you to do different things really just don't want you to get any gains. They want to trick you out of your spot and want to trick you out of your freedom so they can have access to you and control you and manipulate you. I want you to get the gains that you need and never need us. Type in chat, long-term investing is the wave. And too many people spend time analyzing what the 1 year fund level flows are. But if you go down and look, scroll, you need to look at the net fund flow versus the category and what the trajectory is. Anything that you're looking at, you need to look at a 10-year period. 1 year does not give you enough perspective. Some of you are being tricked out of life-changing amounts of money and freedom because others are trying to control how you invest. Safety first. We are in a new decade. January 1st. There will be new opportunities, new chances for new gains. I want to ask you, question of the week for you. What will you do different from 2021 to 2031 that you did not do this decade? So this is a chance where I get to turn it around. Because it's not about the content. It's not about how things are presented and laid out. It's how did you execute? If you were happy with the gains for this decade, type yes. If you were happy with your progress, type yes. If you weren't, type no. Short-term investing lesson of the week. And kudos to the snipers for an amazing session. Put sniper in chat. I love y'all. Y'all killed it this morning. Short-term investing lesson of the week. Most people are better at stopping at 25 trades on the year. If you hit your target 25 times, whether it took you 4 weeks or took you 50 weeks, what percentage would that be? And what dollar amount would you have? Chart of the week. It's really important. The most important chart we've ever covered. What do you want your life to look like in 10 years? Literally, write it in the chat. Especially everybody in Red Panda. 10 years, what do you want your life to look like? Because I want tonight to be a catalyst for that. Season 2 is going to be fire. But the information is only as good as the execution that is applied after. What I wish I knew before. The balance is needed, and any time that we put business before family and friends is a travesty and a grave mistake. So in 2021, I'm gonna be on social a lot less. I'll still be here, and I'm still gonna give you guys some fire, but I've given what I needed to give to help. But now I want to spend more time on the things that I love and only follow the blueprint that works for me, so I can give you guys more of what you need to be able to succeed. Unpopular opinion. You don't need more information about investing. Everything is there. You can go do all the back testing, portfolio construction, all that. At some point, you have to just say, I'm tired of this. I want life to be different. I'm going to buy. And I'm going to buy every month. Type in chat, did you buy every month? Did you take advantage of this crash? Because while some people were panicking, others had a chance to flourish. I want to tell you I love you from the bottom of my heart. I appreciate you dearly. Type in chat what was the biggest lesson that you've learned from Market Mondays this year. If you have not, go watch the first 5. We gave you the blueprint on what to do and the companies to invest in. It is now up to you to decide what 2021 through 2031 will look like. You can do whatever you want to do, but the best structure is the Holy Trinity. Long-term invest first for 30 years, then swing, then short-term invest, and don't change that order. I love you guys. Over and out.